In our strategy, we operate inside a 5-phase framework. We are not predicting headlines. We are tracking liquidity, credit, and sequencing pressure. That is how we stay aligned as cycles evolve. This video is not really about a new Fed chair. It is about how the timing of liquidity changes market behavior. That difference matters more than most people think. We are reviewing a video discussing Kevin Warsh and a potential shift at the Federal Reserve. The creator focuses on how leadership style could change outcomes for stocks, crypto, and metals. You should watch the original video for the full argument and detail. The real question here is not hawkish versus dovish. It is whether liquidity arrives early or late. Markets price that difference long before fundamentals break. The video suggests Warsh favors intervention only during clear emergencies, less steady support, more forceful action after stress appears. Warsh was inside the system during the 2008 crisis. He supported overwhelming liquidity when markets froze, but he later criticized constant balance sheet expansion. This is not about stopping money creation. It is about concentrating it in bursts, smooth liquidity versus lumpy liquidity. Under Powell, liquidity tends to arrive early. Stress is muted before it cascades. Volatility stays lower, but inflation pressure builds. Under a crisis-first approach, stress is allowed to surface. Markets feel more pain before support arrives. Volatility rises earlier in the cycle. Liquidity timing affects funding conditions. Funding affects credit. Credit affects asset prices before the economy shows it. In both regimes, policy still responds to panic. Balance sheets still expand during crises. The long-term endpoint may be similar, but the path to get there matters. Lumpy liquidity compresses timelines. Drawdowns become sharper even if recoveries follow. This primarily impacts Phase 1 and Phase 2 behavior. It raises the probability of faster transitions. It does not eliminate policy support. Risk assets become more sensitive to shocks. Confidence in a constant backstop weakens. Liquidity-driven assets reprice more violently. Central banks still intervene in emergencies. Currency debasement risk remains over time. Policy credibility is tested, not removed. Equities prefer predictability. Uncertainty increases dispersion and volatility. Leadership narrows before it breaks. Crypto behaves like liquidity beta. Delayed support increases drawdowns. Rebounds require confirmed easing, not hope. Metals can dip during liquidity stress, but policy response still supports the long-term thesis. Timing changes more than direction. If this kind of framework-based breakdown is useful, subscribing helps you stay grounded in signals rather than headlines. Each video is designed to improve how you interpret cycles, not to push trades or narratives. This is educational macro commentary only. It is not financial advice. Markets test new regimes quickly. Talk versus action matters. Credibility is built only after stress appears. This raises Phase 2 sensitivity. It increases the value of optionality, and it reinforces sequencing over conviction. We focus on funding conditions, credit spreads, treasury demand, and liquidity plumbing. We do not front-run crises. We wait for confirmation. Liquidity tells the story. We do not need to be early. We just cannot afford to be late.